All right, looks like we are live. So, hello everybody, welcome in. Thank you so much all for being here today. Welcome in to our Hendricks Wealth and Estate Management weekly webinar series. I'm Tom Anderson, one of our newest advisors on staff. Joined with me today on screen are Daniel Leitner and Jim Madel, two of our other financial advisors here. Um, and today, I'm talking about the $10,000 milestone. And I'm really genuinely excited to talk about this topic today because, honestly, it's personal for me. I've been through it recently all myself. I'm 25 years old, so I'm not just here as some financial advisor reading from a textbook. I'm here as somebody who's actually lived through this. I moved out of state right out of college, moved out by myself. I have student loans, like a lot of people my age, and I really had to be intentional and strategic about how I started building my life and my savings while balancing all these real financial demands that can come with being in your mid 20s. Between groceries, between high rent prices, between transportation, between my beautiful blind dog, he's very expensive. All that kind of stuff, it's real talk, and today it's coming from somebody who's lived through it recently. Um, so we're going to talk about, reaching that first $10,000 investment milestone, why it can be so hard, why does it matter, and how you can actually do it. No fluff, no financial jargon that nobody understands. Um, you know, just the content. And before we begin, if you have any questions throughout the course of the webinar, feel free to drop them down in the Q&A section below. There should be a button there. Um, and me or one of these guys will help answer that at the end of the webinar. Without further ado, let's get into it. Why does $10,000 matter so much? Why not 5,000? Why not 50,000? Here's the deal. $10,000 itself, it's kind of like, getting on the highway after driving through every single red light in town. You're not at your destination yet, but now you've started to pick up some momentum. You can get going. Warren Buffett said, somebody is sitting in the shade today because someone planted a tree a long time ago. I love that quote. Just because it's so simple. Nobody plants a tree expecting shade tomorrow. You plant it knowing that you're probably not even going to be the one enjoying it. And if you are, it's not going to be for many years. It's kind of like investing. $10,000, that's your first tree. It's the amount where you start to see compound interest actually do something meaningful. And it's the amount where you shift from thinking, I'm saving money, to actually thinking, I'm an investor. That mental shift is huge. And we'll talk more about why in a minute. Before we dive in, let's just acknowledge something off the jump. Getting that first $10,000 invested, it's not easy. It's not going to be easy, and it's going to take work. And it's not that, people don't want to invest. It's just life has a way of competing for those dollars sometimes. There's always going to be something. The car needs new tires. AC picks the hottest week of the entire year to stop working. Maybe your dog suddenly decides he only likes to eat the premium food now. Money always is going to have a way of staying busy. And if you've ever felt like, you should be further along before you start investing, you're not behind, you're just normal. But building that first chunk of capital, it's going to take planning, it's going to take discipline, maybe even a little bit of structure. But that's exactly what we're here to talk about today. This is the mindset slide. And I know nobody wants to hear the 25-year-old kid talk about mindset, but just hear me out. The biggest lie that we all tell ourselves about investing is that, we'll start when we have more money, when I get the raise, when I pay off this credit card, when life calms down. And I'm going to tell you from experience, um, life doesn't calm down. Life just finds a way to replace one expensive thing with another expensive thing. The mindset shift is this: you don't need a lot to start. You need consistency. The $10,000 milestone can be absolutely reachable for a lot of people if they start to break it down. That's just math. Without compounding, it doesn't take too long to get to $10,000 if you just put things away consistently. And here's the thing about starting small, progress is going to beat perfection every time. I'd rather you invest $50 a month consistently than start and wait 2 years to invest $1,000 all at once. Early action is going to compound. It's not magic, it's just math. And the math heavily favors people who start now, even if they're going to start small. All right, let's talk about what a first portfolio might actually look like for someone. And I want to keep this super simple because the goal today is not for you to get a finance degree today. The goal is just, for you to understand enough to start taking action. Harry Markowitz, who won the Nobel Prize in economics, said diversification is the only free lunch in investing. What he meant by that is it's the only one strategy that reduces your risk without really reducing your returns. It's a pretty good deal. So when you're starting to build that first $10,000 portfolio, you're really thinking about three buckets. First, your stocks, your ETFs. This is where the growth takes place. This is your growth engine. It's where the exciting stuff happens. Over time, it'll build. The second, is bonds and fixed income, and this is really stability for your later years in life. So if this is long-term money, and if you're just getting going now, we're primarily going to be focused on those stocks and ETFs, especially because we'll have time on our side, so you can afford more room for growth. But third, this is your cash, your short-term savings. Think of your emergency fund, your flexibility. Life obviously happens, and you don't want to have to sell off all your new investments just because your car broke down. But it's simple, right? Just three basics. You don't need 15 different accounts and 17 different investment options. Start with three buckets, pick one and go from there. And here's something I wish someone had told me sooner is, there's a huge difference between saving and investing. And most of us spend years only doing one of them. Saving money in a regular savings account right now is basically like watching your money lose value to inflation. If your savings account's paying you 1% interest and inflation is 3%, you're getting poorer while thinking you're being responsible. That's frustrating when you start to think about it. But investing is where it's different. When you invest in these diversified funds, maybe index funds, ETFs, mutual funds, you're starting to put your money to work. You're letting it grow at the rate of the market. Obviously, there's no guarantee. The past is not going to dictate the future, but these can just be a good bet for your long-term growth. And here's the key again, don't have to time it perfectly. Time in the market will always beat timing the market. Meaning it's just better to be invested and stay invested than try to figure out the best moment to buy it, to sell. Nobody knows the perfect moment. Not me, not your smartest friend, not that guy on YouTube or TikTok who's telling you that he made millions of dollars with one weird trick. Just invest consistently and let time do the heavy lifting for you. All right. Practical steps now. This is where we can start to get actually into the how of things because everything I've said, sure, it sounds great in theory, but you're probably sitting there thinking, what do I actually do? Here's your action plan. Step one, set aside consistent monthly savings. Doesn't have to be huge, $100, $200, $300, whatever you can do. The key word is just consistency. Automate it if you can. Take the decision out of your own hands, and your future self will find a way to thank you, even when your present self might be annoyed by it. Step two, open an investing account. If you're early into the years of you earning income, a Roth IRA might be your best friend right now. You contribute after-tax dollars, and then that money grows completely tax-free. Tax-free. When you're pulling it out of retirement, you're not going to owe any tax then at all. None. No tax. At a younger age, this could be an incredible deal because, we might have decades of tax-free growth ahead of us. Step three, pick a couple diversified funds, even just two or three. You don't need a ton to start. Something maybe broad US market. Maybe you're getting into international investments. Just something where you can have a little stability. Done. And step four, just automate those contributions. Set it, forget it. And seriously, the less you have to think about it, the more consistent you'll do it. And now let me tell you some common mistakes people make because I've made some of them myself and I've watched plenty of other people make them as well. Like recently, I was talking to someone. She's super smart. She's successful. She has a great career, and she's definitely capable of investing. But she told me, I'm just waiting for things to calm down before I start investing. And made me think to myself, like calm down. Like when has the market ever sent out a calendar invite that says all clear now, everything's good, everything's predictable from here? Uh, she's been saying that same thing for the last 3 years. In those 3 years, markets went up, markets went down, they went back up again. Companies grew, dividends paid out. Compounding kept doing its thing over and over, with or without her. I mean, here's the reality. The perfect time is obviously going to look a little bit more obvious in hindsight. 3 years ago, might have felt really uncomfortable. There were a lot of ups and downs in between then and now, but investing is always required stepping in before it feels perfectly safe. The best time to start for her probably was 3 years ago, but the second best time for her to start could be now. And another common mistake I see is just overcomplicating it. Can't stress this enough. You don't need a complex strategy just to get going. You don't need to know what a put option is, a call option. You don't need to watch financial news every single morning. Simple beats complicated every single time. Um, and number three, that for regular investors. Number three, just chasing those high risk trends like I was talking about. We've all seen it. Crypto can go crazy. Meme stocks might go crazy. Your cousin might tell you to get into one thing. The TikTok guru might tell you to get in another. And look, I get those might work out sometimes, but especially for your first portfolio, your foundation, you want to aim for boring. You want diversification. You want things that have a good track record. Boring's beautiful when it comes to long-term investing. And Benjamin Graham, who basically invented modern investing analysis, said the investor's chief problem, and maybe even his worst enemy, is likely to be himself. He was right. Get out of your own way. And, I want to show you something now that, could be mind-blowing when you see it for the first time. If we take a look back at history for a second, according to a recent article from SoFi, the S&P 500's annual rate of return over the last 30 years, it's been just about 9%. Now, if somebody invested $10,000 30 years ago and earned something around that range, again, historically speaking, that investment might have grown to $130,000 without adding another dollar. That's the power of compounding. Not flashy, not dramatic, just time doing the heavy lifting. Now, again, of course, past performance, it's not going to be indicative of future results, and markets don't move in straight lines. Returns are never guaranteed. But what history has shown us is that time in the market has consistently been more powerful than ever trying to time the market. Now imagine you kept adding to it, maybe a couple $100 a month. Those numbers could get really exciting really fast. And here's the thing I want you to take away from this slide is not to panic sell when the markets drop. And they're going to drop. Markets go up and down. Every recession in history, it's eventually been followed by a good recovery. The only people who are losing in the stock market scenarios are the ones who sell when it's down and they miss that recovery period. People who win are the ones who stay the course, stay strong, don't sell out of fear. And that might be why having, a coach or a financial advisor with a long-term perspective could matter. When the market drops 20% and your gut's screaming at you to get out because the next big thing's happening and everything's going to zero, you want somebody in your corner who's reminding you of what you're actually trying to accomplish. And all right, we're at the finish line of, my presentation today, and I just want to leave you with this. The hardest step is literally just going to be the first one. Everything I talked about today, mindset shift, 3 buckets, automation, avoiding those mistakes, none of it's going to matter if you don't actually do something when you leave here. So here's your homework for today. 1, open your first investment account if you haven't already. A Roth IRA, if you're eligible, could be a great step for you. Maybe a regular brokerage account, traditional IRA, whatever it might be. Most of them take, less than half an hour to set up, some even 15 minutes. And if you have no idea where to even do that, feel free to reach out to us here and we'd love to help you open one. We can figure out what's best for you and open one in your best interest. And two, maybe pick a few mutual funds, some ETFs, set up some automatic contributions, even if it's $10, $50, $100. Just start. And three, just don't aim for perfection. Track the progress, adjust it as you go. If it's too little, too high, it's a journey, it's not a destination. Nobody starts with a perfect portfolio, and nobody needs to. And four, if you want help putting together a plan that's actually specific to your specific situation, your income, and your goals, we do one-on-one sessions all the time, completely free, complimentary. And I promise you, it's a lot less scary than you think to meet with one of us. I know, when you hear financial advisors, a lot of times it's really an intimidating thing, especially if you have no idea what you're walking yourself into. But you've got this, seriously. Just the fact that you're here today thinking about this is putting you so far ahead of other people, and it's putting you ahead of versions of me in the past that spent way too long making excuses. Start today, and future you will find a way to thank you. But that's everything today. Here's some contact information. All our future webinars will be on this link, hendrickswealth.com. We have a couple good ones coming up. And that's our Algonquin office and our Florida office, as well as we're down here in Bradenton, Florida. But Jim, you have anything to say about the future events or anything?
Yeah, absolutely. And first of all, Tom, awesome job there, walking people through that. And the one thing I'd like to reiterate, there we go, is, whether you're watching this live with us right now or you're watching this as a replay, if you haven't started, like Tom was saying, the best time to start is today, whatever today is. Don't look back if you missed a little bit of time. You can always start. It's never too late. So great job, Tom. We appreciate it. Yeah, with some upcoming webinars next Wednesday. We do these every Wednesday at the same time, so 11:30 Central, 12:30 Eastern. Next week, I will be walking everyone through a topic, the bank of mom and dad, and setting financial boundaries for older children or adult children. Then the week after that, on March 11th, it looks like, Sean Hendricks will be speaking about the three professionals you need in your life. And then the following week, on March 18th, Dan Leitner will be speaking about what really drives long-term investment success. So those are a few of the upcoming events we have. Like Tom said, you can go to hendrickswealth.com, and if you go to the events tab up at the top, you can sign up for or view all of our upcoming events. There's also a link to video archives that we have on our webpage as well. So all of these sessions are recorded and then reposted, so you can view them at any point or pass them along to someone you think might get some benefit out of it. So thanks, Tom.
Yeah. Looking here, it doesn't look like we have any questions. If anybody does have any, we'll probably stick around another minute or so to see if you have any questions. You could throw it in that Q&A box. But again, I want to thank everybody for coming in and attending today. Taking time out of the lunch day can be tough, so always appreciate everybody stepping in.
Yeah. And also, if you don't have any questions today and something pops in your head later on, always feel free to shoot us an email. You can shoot it over to info@hendrickswealth.com, and that'll hit our
Yeah,
inbox and we'll be able to answer it for you.
yeah, all our contact information's on here. Um, give a call out to either of those numbers and email, whatever it may be. Love to help.
Well, you got some praise in the Q&A section, so we
Great
really appreciate it.
information. Thank you.
Thanks for attending.
Yeah,
Very
and
important person that attended that
I know.
seminar, so I appreciate
Looks
it.
like it might be her birthday too. So special
Oh,
thank
that's
you
excellent.
uh, to
Happy
spending
happy
time on your
birthday.
birthday to come out and see the webinar.
Uh,
Um,
all
but
right. I
all
think
right,
we're
it
good
looks
then,
like
Tom.
it's it.
Wrap it
So
up.
yep. Thank you all again for being here. Genuinely hope it was helpful in some kind of way. Maybe made the world of investing a little less intimidating. But again, we're here to help if you need it. And I hope you all have a great rest of your day. Thank you.
Take care, everyone.